What is going on? Welcome back to Orbs. Well, I guess this stream. Anyway, today we're going to be doing something kind of interesting, right? Says Twitch is streaming. YouTube is now also streaming. Yay, we're going to record this as well. For those of you who are new to this lovely endeavor I've got going on, please note that I'm typically only ever posting game content, so this is a leap of faith for me. I'm not entirely sure what I'm doing aside from attempting to learn something. That is the whole point of this. To learn how to do things through watching and learning and taking notes and understanding what is happening and how we can go about what we're doing here. What are we doing exactly? I am learning how to trade. What exactly am I trading? I'm trading Forex. Why? Because that is the pair that a mentor I watched, boot camp specifically, that is the pair the mentor and said boot camp said to trade, and I wish to trade this. I don't wish to trade this. I wish to learn from this in order to better understand how charts work, how I can go about successfully guessing what move goes where, how things work, and of course, eventually easing myself into the process of making money through small gains first. And then as we get more and more comfortable, more and more confident in our guessing ability and our strategy ability, we will hopefully end result be profitable. This particular video will not be posted to Orbs Vault because I don't see it as a gaming stream, though it is a stream, right? This will be posted to the stream's entirety will be posted to Orbs Vault, but throughout this stream, all the good points I make, I'm going to edit down into a smaller video, and that will be headed over to my Orb Plus channel. If you do not know about that channel, be sure to check out the channel description as well as the description of this stream itself. You can find it down below. If you're new, of course, follow, subscribe, that mess. But the video I make from this stream will be headed to Orb Plus, so be sure to check that out as you go on about your day, because this is honestly something I didn't think I'd be getting into until like my late 40s, but here I am, 25 years old, trying to make a life for myself without stress. Not saying this can't be stressful, but that it's possible. So yeah. So what exactly am I doing right now? I'm looking at TradingView. I'm specifically looking at the SP and S&P 500 index chart. I'm not gonna lie, very new, very sketchy territory. Before we get too much further, I'd like to review my notes. I want to know exactly what's going on. So we're gonna blow this way up. I'm gonna throw this right there for all to see. I'm gonna blow up a little bit further because I think you guys ought to be able to read this quite well. So the general thing. Golden. You can see stuff. For those beginning to trade, I think it's best to understand how charts work and essentially the building blocks. These are notes I've taken from TJR Trades. That is the person I took the bootcamp with, and for the best reference possible, I'm going to be using the S&P 500 strictly to learn how charts move and how I'm going to implement a strategy. I have a demo account, but I have done nothing with it because TradingView does not like the demo account I've chosen, the broker I've chosen, for whatever reason. Don't know, don't care. Simply working on that. I hope I got the category right on Twitch for this being a business thing, because hi. How do I stop? I can pause. One moment. I will be right back. Wow. What am I doing? I'm doing this right here. I need to take this and just. So, for those of you who were just here not a little while ago, I am sorry. All of what's up there is the truth. I had a baby in my arms. That was my nephew, by the way. Um, he had passed out, and I had to take care of him for a little bit. Yeah, we're gonna continue with the stream. I've been streaming for an hour and 53 minutes, and it's been nonstop chaos since I've started. Pardon me. I know I know the business type on the little stream thing is like finicky. I am broadcasting to a specific audience. I am sorry for taking up your time. We're getting into the stream now. Right now, we're getting into it. I hope you know we're getting into it now. I have to figure this out because I have about an hour and 53 minutes worth of video I have to cut completely out. So, luckily, I got it like on mic that I was muted. I could just. The only difficult part is if I want to include all of this right here. That's the only difficult part. I cannot believe I just did that. So, I have to do this because, boom. Sure, I'll save that. Yeah, why not? Boom. But we are here to learn how to trade. Trade what? I am trying to trade nothing because I'm learning. Why am I learning? Because I'm new. Why am I new? Because I have short-term goals and I'd like to see them met. I don't really have time during the day to do anything, and I'm stuck either at home in the middle of the night because guess what? Everywhere else is closed. I have zero control over my current schedule. So what I intend to do about my schedule is ride with the punches. As mean as it sounds, as gruesome as it's going to get, there is no real way for me to change my schedule without losing a major support. Everywhere I go essentially has the same opinion that you need 3 to 6 months worth of life expenses. That is every bill you can think of off the top of your head. Subtract your subscriptions that do not matter to your overall life and well-being, and then you will from there invest a separate savings account which you are drawing money in to make a profit off of, potentially. At no point in this stream am I to be taken seriously as though I'm giving you financial advice. I am not here to advise you on how you manage your finances. I am here to learn. Period. Should I change it from business category over to educational? Because I'm not entirely sure what I should do. Because right now I'm streaming both YouTube and Twitch, right? I don't want to take YouTube video and try to like put that on Twitch. That's not what I'm about. I'm trying to put my notes into action. I think that's where I need to start because I don't know. I have no actual experience with entering a market, boom, and exiting a market successfully. Nor have I failed yet. I'll correct myself. I have failed on Robinhood several times from attempting to implement strategies without actually putting anything down, without actually, taking anything. And is my audio even moving? Am I muted? Nope. I'm good. I'm good. Sorry, I had to check that OBS. Had to make sure. Pardon me. But I am making sure that essentially we are golden all the way around. So right now, what I'm doing is going over notes. I want to see what you guys think about these notes. If you are on stream right now and you can 100% say, yes, I have experience and I know where you can tweak your notes to better. What? Hang on again. hopefully that doesn't happen again. But I should have seen that earlier. But yeah, we are looking at notes and attempting to learn from notes and a whole bunch of other stuff. Okay, so at first, I always forget how pungent chocolate-covered strawberries are. Whew. Very good though. Anyway, this is my tab for the trade strat and my current progress with every single trade I've made. I made 2 different side notes. I've got these notes here. These notes specifically are all the notes I've taken over the past year and a half from studying this guy here, TJR Trades, on YouTube. And combining it with other strategies I found across the internet that have shown and proven to be successful over a large span of time with many different variables that we'll get to here in a second. This stream is to outline the basics and whether or not these notes are valid. Let's get into these notes, shall we? First off, in order to read a chart, I'm gonna minimize this so that's out the way. In order to read a chart, like this one specifically, you have your candlesticks. Green means up, red means down. More accurately, more specifically, green means it opens low and closes high. Red means it opens high and closes low. Understand that. The bodies of the wicks indicate price, how far that price went up and down. Not necessarily that one price only went up or not one price only went down. It shows the range of movement during that span of candles. So for right now, right, we are on the hour time frame. 1 hour time frame right there. Boom. During this span of candle, during 1 hour, the price moved up here, but guess what? It didn't move that far. And throughout this candle, this entire candle, it moved from down here all the way up there to the top of that wick. See the dotted line? See the top of the wick right there? We're talking about this candle right here, right? Right? Okay, cool. So we also have candles like this, where price, guess what, moved all over the place and went all the way down there and all the way up here. But check out the body. The body still counts for the full hour. The body also indicates to us a pattern that says, okay, the price doesn't know where it wants to go. Because as you can see, it moved very, very, very much. A whole lot. And as a result, we get something like this, where you have 2 large wicks on both sides of that body, and the body is essentially representing the time at that point because it doesn't have an accurate representation of up or down like this candle does right here. As you can see, it moved from, I'm going to get really close to this candle so you can see it. We're even going to elongate it a little bit so you have a better picture. It went from the bottom of this wick all the way up here. But the clear indicator was that the price moved down. So the body of the candle is going to be a little bit larger. We have clear, this is what I'm assuming is sell power. Essentially, people are selling their stocks more than they are buying. And as a result, we have large body candles that go down. If it were obvious that the imbalance between buyers and sellers were leaning toward the seller side of things. And that's where it drives down. When you sell a stock, it goes down because guess what? Price and demand? Not price and demand. What is it called? Yeah, the demand is less because there is a lot more in the market. Supply and demand. There we go. Because there's more supply in the market, the demand is lower. Ergo, the price is going to go lower because guess what? People can find them for cheaper to buy. That's what this goes down for. Someone has sold all their supply, and so the demand dropped for it because there was a lot in the market. When it needed to come back in, the demand rose, the price rose. Because there wasn't enough supply, it went up. So, our goal is to accurately, to the best of our ability, predict the future in a way that allows us to take a profit off of these green candles up here. That is my basic understanding. That is my know-how. I think that's the all of what I need to do. Of course, time moves forward. We read from left to right, so left to right, past to present. And as you can see, right there is our current price. As you can see, it is also not moving because I'm streaming on a Saturday night. So there is no real, what is it called? There is no real price movement at the moment. And I'm working with a free version of this software and I can't rewind. So what we're going to do is essentially this. I can only do this for so long before it says, oh, you can't do that because you have to pay a subscription and all that mess. Which I'm not entirely against, but yeah. So, oh gosh, until that happens and I lose all sense of where... Boom, there we go. There we go, boom. So this is the daily. No, this is the weekly. What am I doing? Yep. So again, for specific time frames, it's universal. Each one of these candles is a single week span, as you can see at the very bottom, right down here. See August, see October. These are the weeks between August and October. So September is like these 4, 3, somewhere these one of these, right? You can actually see it right there, August, September. So it starts there and it ends there. That's October. This is September. Starts there on the red, ends on the green. But it's the same thing all the way around, essentially. Each one of these candles is a time in which price moved, and you have the bottom of the candle up on the wick that signals that, and then if it can't decide whether or not it wants to do what it wants to do, sellers can't make up their mind, so price moved down because demand dropped. Demand dropped. And they continuously put in the market. And this could easily be something related to something completely different. But either way, this candle represents an imbalance. And of course, due to weakness in this right here, the demand dropped and the price plummeted, for a lack of better understanding. My understanding is, based on the strategies that I have been learning, is they implement a strategy. They collect a bias, essentially what price wants to do for the day or the week, and essentially you look at the weekly time frame. As we can see, this is a clear uptrend. An uptrend is anything that goes from down, so the very, very lowest low, all the way up to this highest high, indicated by a straight line of up, down, up, right? Just in a continuous line up. The only other two patterns that I really know anything about, because I haven't seen anything else, is pretty much the reverse, where it goes from the up back down to the down. And you can clearly see that with the red marker here. Again, each one of these candles on this specific time frame represents a single week. And this is indicative of a downtrend when it just goes straight down like that, straight down, straight down, straight down, straight down. And there's a collection of candles that represent a trend. So from here all the way up here is a single move up. And then from here to here, collection of candles, mind you, is a single move down, downtrend. Strategy, because I am now way off target. Look at the price for weekly. Yay, it's going up. Look at the price for daily. Boom. It's very hard to see if it's zoomed way to flip in, but it's also going up. Quick tip. My understanding is the market isn't going to always be in a straight up, otherwise, like always green, because at that point, no one would have a real reason to enter the market to make a profit or to sell. if there were no sell, there would be no buy. It's like a yin yang type deal. But my thought is the I don't really know how to explain this because there are many different patterns, right? The only other pattern aside from the up and down trend is the consolidation, where it just goes into a straight line, or more accurately, it goes into like this right here, where it just up, down, up, down, up, down, up, down, up, down, and it just bounces off of this the entire time. Not seeing really any, because this is also the daily time frame. It's going to be a lot harder to find it on, I think, this time frame, because these time frames strictly show a large amount of time where price is just constantly moving, and that is essentially what's happening here. Rarely will you see something like this right here, where it just takes off at this right here. What was I going to say? I was going to say something about this right here. This is not technically a consolidation, right? I think this is like a retest. I don't know what it's called. Chat would know. If you know, comment it. If you know, say something about it, because I don't know. My understanding is right here shows an imbalance. An imbalance to what? The sell side. Because right now, as we can see, there's a lot of people selling and the price dropped dramatically. But the buyers bought up a lot, raising the demand, raising the price. Because the demand increased, so price increased. People are going to want more. Boom. Yeah. The imbalance to the sell side on an uptrend essentially says, okay, and this is my interpretation of what I have learned over the past couple of years, is that when it shows an imbalance like this, there is typically going to be a strong reaction of buyers just buying up the market left, right, and center. And this is essentially people who do not know what they're doing, or the company just genuinely like losing their supply over a long span of time. So as a result, price raises and it skyrockets. And of course, you can see the imbalance here where the price dropped and it didn't know what it wanted to do. The price rose, even though there were few buyers, or very, very small amount of action for this specific day, right? And so we have that indicator, and it tested again and just plummeted. Of course, lower high, lower low. I think it's based off of what has happened that we can make a guess on what is going to happen. I'm just going to continue on my roll the way I have it. But yeah, we make a bias off of the daily and the weekly. We know it's going in an uptrend. From what I've experienced recently, I was taught that in order to get an accurate, a decent, really good bias, is to take the previous day. So this right here is Friday, right? This right here is Thursday. I did a little research on Friday to better prepare myself to compare the 2 days, right? So on Thursday specifically, we mark our high, we mark our low for that day specific, and then we jot down all the way to the hour time frame. We're gonna do this right here. Zoom way out for a second. I want to find where Wednesday ends and Thursday begins, because that is where things will get interesting. Boom. Thursday began there. So we don't want to mark this. Why? Because it's in the middle of a movement. As you can see, it is neither the lowest low nor is it the highest high, which I'm pretty sure that is Friday right there. For Thursday, the highest high was there, I think. But it doesn't count as a high on the red candles. It only counts as a high on the green candles, as far as I know. Yeah, Thursday won. So yeah, that's the highest high on Thursday. Lowest low is on this. We just mark that using this right here. Horizontal ray, boom, highest high Thursday, and then boom, lowest low on Thursday specifically. We're not going further back from that. We're going from this way. And again, this is the hour time frame, keep in mind. For Friday, let's see, Thursday, we want to do red because it is the past. Boom, boom. And it is from the past that we get our answer for the future. Anyway, we have horizontal ray again. This is our high for Friday. Boom. We're going to keep this green because we're going to assume that this day has not happened yet. And our lowest low is right there for Friday. Try and get that as best as possible. Boom. Yay. So we now have our two price ranges. We're looking for action within this green and this red. What are we looking for specifically off of this bias? In my genuine opinion, we're looking for continuation of an uptrend. Why? Because the higher time frame, the day and the week, are on a constant uptrend. We want it to continue up. But before it can continue up from its current move, because guess what? We've ended the day on an up candle. We need it to come back down. How far down? It either needs to test this right here, this right here, this right here, or this way down here. I'm going to take a step back right quick. I'm going to take one leap back. Because it's a continuation, we can't look for fair value gaps, which is something that looks like this candle right here. Giant green candle, right? Essentially, a fair value gap is anything a candle on both sides has no wick going down the middle. So take this candle right here, this green candle, see this wick right here? It would have to come all the way down here to clear. And just so we're clear, I'm only talking about the candle. In this specific pattern right here, we have this. Big leg down, big green up. Why isn't that? That's why this is not considered a fair value gap, because it is essentially going back towards this liquidity that was here before, my understanding. For those of you who are currently watching the streams, I am sorry. Why am I sorry? Because I know the quality is garbage. Why is it garbage? Because I have bad internet and I'm streaming to two services at the same time. Twitch and YouTube, right? If you want to see this entire stream in crisp, clear quality, head over to Orb Plus or Orb's Vault. I'll be posting this entire stream on Orb's Vault, and I'll be chopping up this stream as a second deal in order to get a crisp, clear video across on Orb Plus, so there is no miscommunication on what I'm doing, why I'm doing it, and how we're going about it. And again, none of this is to be taken as literal financial decision making for you. This is me learning the chart, how to read it, and how to better myself as a day trader if I want to go that route. The whole process, the whole reason I'm streaming to you is to learn from you, those who might be more experienced, what I can improve on, where I need to be more intrinsic, where I can be less intrinsic, the like. Trying to get it down to a fine-tuned regimen versus me going in and guessing every step of the way. Again, I understand that trading is essentially guessing what is going to happen in order to make a better profit based on what has already happened in the past, using our notes that we are here, right? Based on what has happened in the past, where we can make a leap from. In all complete honesty, because this is the hour time frame, it's so there are like what 8 hours to a single market deal, right? I think we can make a better inference on what is going to happen based off of what we have over here. As you see, between these two green is one day, between these two red is another, and they are the exact same distance apart, 8 hours, 8 hours. If we did this all the way down, we can pretty much determine that this is like this right here might be the rest of the week: Wednesday, Tuesday, Monday, and then Friday, Thursday, Wednesday, Tuesday, Monday, the like, right? Did I go down a rabbit hole? Probably. Let's try and get back on track. I want to try and make the best with what I can out of what I have in front of me. Right now I'm on the hourly time frame. I'm going to refer to my notes. Boom. Here are my notes. There are 5 days in 1 week. There are 24 hours in a day. 9 weeks in 3 months. 60 minutes in an hour. 180 minutes in 4 hours. Yes, they're all jumbled up. That's on purpose. The generalization of these notes, the summarization as best as I could get it, and a decent strategy to look for. When watching for take profits, this is before you trade. To get a hit, once hit, the first time remove 50% of the total amount in order to prevent loss of trade. So this is like skipping ahead a little, but I'll tell you what, we'll skip this entire paragraph right here. We're going to go down here instead. In order to create a bias based on what the market has to give us, we first need to take into account the overall trend on every time frame. Every time frame. I have changed that as a result of what I have watched and seen and have learned. Time on every time frame? No. On the weekly, on the daily, on the hourly. Start with those three. Keep it simple. Once all patterns have been recognized, I want to find areas of high confluence. High confluence is areas, I should change confluence to volatility, I guess. I think volatility is the rate, the rate of change based on supply and demand. How high a price goes, how low a price goes. What's an area of high volatility? Well, anything that looks like this right here, really. It went up and went down and then skyrocketed way up. Again, I'm taking this into account. Oh wait, sorry, you can't see that. Hang on. Bloop. There we go. So there is a large amount of volatility in this. Again, this is the hour time frame. We have down, skyrocket up, a little bit down, skyrocket up. It's not as drastic straight line as this, but it is still a continuous uptrend that we're looking at. We're looking in between these candles, specifically these two sets right here, for a confirmation of high volatility. Again, high volatility is anything that looks kind of like this, where it's constantly up, down, and there's a solid downtrend. This is more of a consolidation right here, but we have a breakout downtrend and then skyrocket up. We waited, like this right here is a double bottom that could get retested, and boom, it did its thing down here, and as a result, it went up, per a video I saw. We're looking for stuff like this though, and we're going to go down to the 30-minute time frame just to see what's up. Again, we're looking at between these two sets right here, right? And a little bit behind that just to see what exactly the market did and what we can do from it. Right now I'm looking at 30-minute time frame, and you know what? We're going to keep it like this for a little bit. We have a clear right here. From here to about here was a liquidity or a fair value gap. It got swept under this right here, under these green candles that took this, as well as this red candle and these for a second time. And it went up. TJR Trades taught about order blocks, and I never really understood the concept. Let's continue with this though. These notes. Find areas high volatility. I don't want the market to hardly move, nor do I want it to jump all over the place. So that is an oxymoron. That sentence alone. I want it to jump all over the place, but over a large span. I don't want it jumping all over the place in a very short span of candles, because that increases the likelihood of me losing versus winning and taking profit. I'd much rather wait for areas of high volatility in order to begin considering to trade. That's like doubling down on what I just said, except the high volatility and high confluence are the exact same thing. The only difference is high volatility is this up, down, up, down, up, down over a large span of time. The confluences is my ability to go into any time frame and look for those confluences with relative ease, because there is so much volatility. It becomes more apparent what the market wants to do based off what it has done through large amounts of volatility with an equal amount of opportunities to find those confluences in time to make that decision whether or not to trade. After which we find what I just described. I'm going to separate that. After we find an area of high confluence and volatility, we then start on the daily understanding where price wants to go based on previous fair value gaps. Mark each of the highs or lows on the weekly for the week. So I am dialing it down to a more focused aspect because my goals are not long term, they are short term. And my goals are not going to change. My long term goals are not changing for a long time. That's what makes them long term. My short term goals, assuming this goes well and I can make it successfully, will be those short term goals. But before I can get to them, I have to make a profit. I have to learn this fine tuned. And I understand there's always a chance that I might not be good at this. I know this. I'm walking into it knowing I'm not going to be good or great. I'm just walking into it with no doubt that something is going to happen and I will have learned my lesson from it. Yeah. Going to this note though. After which we then start on the daily understanding where price wants to go based on previous fair value gaps. Mark the highs and lows for the weekly for the week. Get an overview and understand that because a lower time frame is moving down, that doesn't mean the higher time frame is. That's why we looked at the weekly and the daily first. For instance, let's go back to the weekly. This is over. Each candle is worth a week, right? Genuine uptrend. There is no randomness except for this right here. And this is a fake out. This is one of those things that just because the trend is moving down now, this high is lower than this high, does not mean the overall trend for the week is. We are in a strong uptrend right now for the week. What about the daily? What does the daily look like? We are also in a strong uptrend. And of course, I know 5 of these candles is a single week. From the weekly, because it's such a strong uptrend, you're going to be able to see this right here. But if you zoom into this right here, if you zoom into this right here, if you zoom into, right here, this low right there, right? There are plenty of people who will make the mistake in thinking, because the market is low, this is a low high here, and it is a low, it's a higher low. It didn't break trend except from this candle right here. Fake out. As a result, people will lose money here, and instead it'll just keep rising instead of going further down. So let's go back to this. Oh well, you could not see that last bit because this was in the way. Why did that not work? That was weird. I don't know why that did not work. I thought I had that down and everything. So I have to ask. Okay, so I know what I'm doing wrong. That's fixed. But on the 4-hour specifically. So I'm not doing the 4-hour, I'm doing the 1-hour. I'm changing how I'm doing things as I go because I want, you know what? Previous day. Because I'm a day trader and it will be daily that I take trades. Previous fair value gaps. Get an overview and understand it's going to be down. Doesn't mean it's the higher one is. Cool. On the 4-hour, I'm going to correct that 1 hour because it has a broader number of candles and you can see a little bit better. Begin preparing building blocks, identifying the most recent liquidity sweep before current price action. What does that mean? That says on the hour. Hour. Boom. Oh, wait. Sorry. I have to do this. Close. Yay. Good. Awesome. On the hourly, we're going to gold. We're looking for fair value gaps. Well, that makes sense. It makes sense to say fair value gaps if the volatility were extreme. It's currently, in my opinion, not super extreme because I'm looking at it. That wouldn't count. That wouldn't count. This right here might. From this candle right here, fair value gap. Actually, I'm going to use the rectangle tool if I can find it. Where is it? This right here. I am learning TradingView as I go as well. Nope. Where in the world? Where is it? It's not that. Nope, not that. There we go, rectangle. Yay. So from this right here to that right there. I think I've already labeled this as a fair value gap. I think, if I'm not mistaken. The only reason why I don't think this is a fair value gap is because the other side, this right here, this has already gone down. This is essentially gone up and swept this. So this would not be considered a fair value gap. What happened? What you need? What's going on? I live with a lot of people. They need everything. But moving back to this, I don't think this is a fair value gap because of this movement down. This leg down would be understandable if it weren't like, if this was like lower, there was less movement in price right here, I think this would be considered a fair value gap, in my honest opinion. I think, if anything, there's a point actually right here in this candle. We're going to zoom way in for this too. Boom. There might be one spot, one single solitary spot. That right there. It's small. It's small, Mr. Krabs. It's very, very small. This is a fair value gap. When candle on one side, candle on the other. Neither wick touches it, right? And typically, what'll happen is it'll be on a single side. So you'll have red candle on this side, right? Green candle on this side, red candle on this side. This green candle, this will be like super small up and low. This will be super small up high. This big green candle will shoot way up. A large green candle, right? Similar to this one. Essentially, actually, you know what? Because that makes more sense. Red candle on one side, red candle on the other. Large green leg up, liquidity. Boom. Right there, I think. Correct me if I'm wrong, chat. Feel free to do your research, figure that out, because I think that's more accurate of a representation when it comes to fair value gaps. Fair value gaps is when a price action moves so high or so low that neither candle on either side in the reverse direction have wicks or bodies that encompass or engulf the single candle. Or in this instance, a group of candles that have a single leg up or down, right? Essentially, from what I've learned, is that fair value gaps are a magnet for what price wants to do. Price wants to come back down and clear this fair value gap because there is just liquidity sitting here ready for the taking, but again, no one's taken it yet. Again, I might be wrong about this fair value gap right here. Why? Because I'm looking at this leg down and it coming back up, and this candle engulfing this leg completely. There is no, like, it was low, the buyer strength came back in, pushed the demand back up, and then boom, higher price, and it swept that. It swept the amount that was in the market. Bought it all up. But that's essentially what I think a fair value gap is when that's there. And just so we're clear, boom, liquidity sweep. I think this is also a liquidity sweep. Again, I think I'm wrong about fair value gap on that, but maybe this right here is the leg up. This right here is the liquidity sweep on the way down, and it fair value gaps up, or again, it goes down, sweeps this, creates a fair value gap. Then identify a break of structure to determine where market wants to go and make sure the daily time frame isn't break of structuring to the flip side. So, as close as we can with this, I believe, better gist is to look for one on the 2 days we are working with currently. I mean, maybe that might be the case. I'm not entirely sure. There's so much happening on this one screen, though, that it's difficult even for me to figure out. Again, I'm new. I'm learning as I'm going. I want to look down there and say that, yes, is a fair value gap, but I think I know I'm wrong. I think I'm wrong. This complete, like, I'm pretty sure this is an order block right here, which means it might be coming back down. Not that the daily or the weekly is coming back down, but this particular move that it's wanting to make, because guess what? This is the end of the week. This between the green is Friday. This right here is Friday this way. And then like over here is Thursday coming this way. You know what? I better mark that. Boom. Thursday. Boom. Friday. We're gonna leave those. We're gonna put those white. Good. Yay. So, to determine where a market wants to go and make sure the daily time frame isn't break of structuring to the flip side. I think we did it pretty well. I can't identify a decent liquidity sweep aside from the leg up here and potentially this right here, right? There we go. And sorry, I'm looking at the other computer that's actually streaming this stuff, and it looks like it's lagging just a bit because every time I click on the trading view, my notepad goes away, and I can still see it on the other screen. I'm like, why? What I said was, I think this right here is the liquidity sweep. I think this right here might be a second liquidity sweep, and I've maybe misinterpreted something on this right here, potentially. Going to this, though, looking for a liquidity sweep within these two red and between this white and white. I'm not seeing one. I really isn't. So we have Wednesday here. Wednesday starts there. We're actually going to boom, Wednesday, Tuesday, Monday. Just so we're clear. Start, 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 start. Boom. These are market opens, by the way. This past week, we had, I want to say this right here might be a liquidity sweep, but there's a gap here, and maybe I can, no gaps. Does that work? It does. Kinda. So I think this is honestly the best I'm gonna get is this the rectangle? I think this is the rectangle. So between here and here, I want to say, is our fair value gap. Because there are, aside from this and this right here, actually, red candle. Let's go there. Boom. Put that there. This is our fair value gap. If I'm sure about that. This right here would be the liquidity sweep up to this point. Because right here, we're actually taking care of a recent high from Monday. The high of Monday. We're sweeping up that liquidity, and we, as a result, have a fair value gap. And then price wanted to move up. It's going to open up our notepad one more time. Once it's confirmed that the daily time frame isn't break of structuring, then move to identify either an order block for confirmation. Market will be filling orders from previous liquidity sweep. That helps out a lot, actually. So essentially, find an order block right here to confirm whether or not market is going to fill orders. I don't see an order block anywhere from the previous liquidity sweep. So this right here, I don't see an order block. Maybe this right here, someone pushed it down even though someone pulled it up. This may have been the order block, but it didn't make a new low, so it continued up. And as a result, we have a fair value gap right after that, indicating that the orders have been filled. They were. Then wait for the next step in the trading plan before moving on to the next step. Pretty simple. When enacting my trading plan on any time frame, under a confident daily bias, if at any point one of the building blocks does not appear, then de-risk until equilibrium based on the most recent higher and low. I believe higher high and lower low. Confirm a discount price. So, I'm going to take notes away for a second. Let's dial back. We have the start of the move. I'm gonna have so much editing to do because they keep interrupting. I need to put like a red light on the inside of my door and just shut up. Leave me alone for a second. Anyway, going back to the notes, we have a constant move. We are confident that the price is just going to go up because of the daily, because of the weekly. Going down to the hour, we're looking for the start of the week, which is a solid, strong leg up, right? Or wait, I want to wait till after Monday to start trading, honestly. So that way I have a confident leg down, right? Not one, but two candles down, and then a confirmation that this is in fact an order block. The price was filled, even though price wanted to move up. Someone didn't want it to, so they brought it back down. Someone sold. And as a result, we have a confident leg up. Not liquidity sweep. That's what this was for. That's what this right here was for. This swept all of this. And then this right here was our order block. And then leg up into a fair value gap. In line with trend. Our next step was as close to recent price as we can get. What was that step? What did that say exactly? Once it's confirmed daily time frame isn't break structured, then move to identify either an order block for confirmation market will be filling orders. We found an order block, but it did not confirm, and that it confirmed orders have been filled, or fair value gap indicating that the orders have been filled, and then wait for the next step in trading plan. The next step is identifying that fair value gap, this right here, and understanding that price is going to want to come back down into this. This is an imbalance, a very, very big imbalance, in fact, to the buyer side. So sellers are going to want to try and come back down here, try and get the price down as low as possible for an optimal entry, and so it can bounce back up. Because you didn't see it. Come on. Because it's just going to record anyway. We're looking for price currently next week to come back down into this. Once it comes back down, that's when we look at our highest high and our lowest low for the, not the past week, but the most recent, like pick a number of candles and then just, right? We can delete this now because we're not looking for anything else on the hourly time frame. Instead, we are running for this right here. Come here, candles. Boom. Yay. All right, we're looking for and at. Under confident daily bias, if at any point one of the building blocks does not appear, then de-risk until equilibrium based on the most recent higher high and lower low, confirm a discount price. So at this point in time, we're looking for higher high and higher low. The most recent. So per the week or within the past week, we're looking at, you know what, let's just do this. Let's go back Monday. Start of Monday. Boom. That's start of last week. This is start of this week. To differentiate here, we're going to put this to blue. Bright blue. Bam. Last week, this week. Essentially, we're looking for the high and low within this span of time, because guess what? It is either going to react based off of this fair value gap that we were discussing, or not this one, this fair value gap right here. As a result, it's going to come down. I think I had it right the first time when I said I want to wait till Tuesday, because as you can see here for the week, this is the low for this specific week because we're past Monday. Pre-market Monday, like the end of Friday, yeah, the end of Friday is not pre-market Monday, but you get the point. It's closed. That technically is the most recent low. Boom. Do I want to mark that? I don't know. I think what I want to do is play it safe within the week. Boom. That is the lowest low for this week specifically, right? What do I want to mark this? Sure, yellow, because it's showing liquidity and where it is and just what we're talking about. And that's on this candle right here, just so we're on the same page. Just go ahead and just move it right there. Good. It's out the way. Boom. The highest high is up here towards this green candle. We're going to go ahead and move this green candle over out the way. We're going to change that. This is the highest high this week. Did this have a wick to it? It did. Boom, right there. So here's our golden zone, our price action movement, whatever you want to call it, I guess. But price for the week went as low as this and as high as this, right? The goal is to get it to, you can't get price to do anything. You don't control price. Your goal is to guess as best as you can. And I think what's going to happen is it's going to come back down into this fair value gap that we were discussing about a second ago. And once it touches this fair value gap, it's going to shoot back up. And here's another tool. One tool that is an indicator. It's not meant to confirm whether or not price is a thing or not, but this is what's called a Fibonacci tool. This thing is apparently everyone's best friend because it depicts high confluence zones that price moves and reacts to, essentially, right? So what we're looking for is a leg down back into fair value gap here. And if we high, high, low, low, we can confidently see where that fair value gap is in this blue zone right here. This is usually called 0.382, but this is a 0.618. We're looking for price to move past this middle and into this blue. What do we want to see from price in this blue? We want to see it come into wick. Body all does not matter. We're looking for the wick of a candle to either touch this blue or go deep into this blue. Buy, enter off a trade, and then ride the continuation up into a higher price so we can take profit from that. And I mean, essentially, yeah, that's essentially what I think I've learned from TJR is wait for it to drop down into here and then watch it move up as it goes. And this is the setup I learned from TJR, I think, for taking not longs, but day long trades for a week span. So one trade per week, right? Essentially, you do all your work Monday on a looky, see, doey. What is market going to do based off of what I've saw Monday? Tuesday, market opens and things can occur. The best bet is to look at it and honestly just apply a strategy until you think it works. Um, I don't really know. I don't. That's bad advice off that last sentence. I'm not entirely sure exactly what to do at this point. We have our high low. We've determined what we want price to do. We want price to do it. Doesn't necessarily mean it will. So what has happened is now that we're in an uptrend, I'm looking at the flip side of things. What if it doesn't go bad? We're looking at the most likely scenario to happen, which is price wants to move up. That is what every time frame is telling us. It wants to move way up. But at the same time, our fair value gap indicates price wants to come down first and then come back up. So what do we do if it doesn't come down first? I think at that point, it's a good idea to wait. I think. Why do I think? Because the fear of missing out. And that is probably a bad thing, but it is the most logical reasoning I think I can have at the moment is to wait for confirmation whether or not price wants to go down. Again, I think the TJR thing, the bootcamp he taught was solely based off a week span of trading, not necessarily shorts. So shorts being like taking trades well into the not 5 second, but the not what I wanted to do, like way down into the 5 minute, 3 minute, 1 minute area, right? Because at the minute, yes, price moves a little bit, but there's also a lot more minutes in a day versus in an hour. Well, same amount of minutes, but you get the point. Again, I think this is for a week span. Essentially, what I want to do now is go into a smaller time frame. Now that we have our confluences for this week in particular, this is this current week that start to close. We have where price wants to go. However, this is not the only time frame we can take a trade off of. We have shorter time frames elsewhere, and price is again moving very, very small on that frame. So I think let's do this. We have our high, we have our low. Highest high, highest low. What I want to do is I want to take this right here. I want to hide this from below. I want to hide this from below. this from below. I want to hide. I'm going to change this back to green. I want to hide this from low. Boom. I want to keep the lowest low of this week and the highest high of this week visible. So what I'm going to do is I'm going to add another line just above this one. Boom. We're going to change that to yellow. Boom. Yay. These two gold are going to be visible. The white will be visible. I don't care about this blue line anymore because I am confident in my ability to see whether or not, like the past week, based off of the hour time frame. I'm confident in that. Good grief. Go away. What I want to do is go down into the chat comment section. Those of you on YouTube who are watching and are curious about it, I want to know your opinion on what the next time frame ought to be, because I've heard everywhere between 30 minutes and 3 minutes. I have not heard less than 3 minutes, because according to sources, TJR, other YouTubers, shoot, even Chat GPT, for whatever reason, they recommend 3 minutes because it holds the most information with obvious movements over the shortest span of time that you can really go into a chart with, right? I think for this stream, I want to work with the 30 minute, the 10 minute, and the 3 minute, because they're at 10, 10, 10 intervals, right? For 30 minute, there's not much you can really see off of this aside from what we've already discussed. We have a fair value gap here. That's what we just discussed. And then, of course, higher high, higher low. It just keeps going up and up. My understanding of what I'm looking at here, the volume, the number of people versus the amount of supply, it's currently decreasing, going up. The supply specifically is decreasing on this move, but it's increasing as we go further this way. In other words, price didn't know what it wanted to do here, and as a result, this became a hot topic area of question, right? Buyers came up, took up all the price, and as you can see, that one, what was that, 30 minute span right there, that one 30-minute candle turned into a I don't know what I want to do, and as a result, buyers pushed the price even higher. But as a result, the sell side said no. There was a clear imbalance of buyers, so the sell side came in, said no, and brought the price back down. Of course, buyers came back in. Yeah, you get the gist on that. My point is, from what, this candle here, this big candle, this small candle, from these two candles right here, all the way to this candle here, there was a small amount of sellers. The volume was lesser on those sell side, and as a result, the buy side went way up, right? Continue all the way through to this right here. Because of this imbalance, the sell side went back into motion. They had their recovery period here, and as a result, they came back hard hitting, and now we're looking at the sell side decreasing, right? And of course, we have one massive candle here that has already been taken up with sell orders. Price went high, they sold, and then now we're moving back into an uptrend from what I could tell. Again, what we want price to do is come down into this. Not that it will. If I had to guess, I'm going to say it's not going to, based off of an entire week's worth of stuff. We've already got our bottom right here, our bottom candle, and it looks like it has not been tested yet, which we're waiting for on that right there. I don't know. Well, I could be wrong. Nah, I'm definitely wrong. All the way wrong. I'm sick because I looked at a strategy on YouTube that said look for double bottoms like this right here, where you have a low here and a low here, which is candle. A low is when price moves so low that a candle is sticking out the bottom of the bottom of the candle. The wick is sticking out the bottom of the candle body. To clarify on that, way better. But you essentially look at the wick on this and the wick on this. Here's a low, right here, right? And from that, we can make an inference that from this right here, we're waiting for price to come back down and test this level again, because again, market doesn't know what it wants to do on the buy side. So sellers are testing the buyers and creating interference, or was it resistance? Correct me if I'm wrong. That might be the terminology for it. Correct. I'm not entirely sure. Is creating the resistance needed, and so it's testing it. Buyers came in, pushed the price higher. Okay, no big deal. Sellers came in stronger and retested this same level. And as a result, it reacted and pushed the price even higher. That was within the span of Monday, like Friday to Tuesday. Monday was break time, I guess, for uh, buyers. So I think from that strategy, uh, the best strategy from this right here was for it to retest, and then the confirmation right here with the double candle when it pushed lower and tested this confirmation for this low over here. This was the buy opportunity many traders were looking for, I'm guessing on Tuesday, to further their approach up. Just looking at this setup right here, this double bottom. Again, they would have had to wait. They would have been looking at the chart like this right here. I kind of wish. Yeah, never mind. I could do that. They'd have been looking at the chart like this. The green candle next to this red right here isn't even there. They would have had to wait for a second candle to come in and test that low on this right here. And as a result of that being tested, we had a spike up. Again, there are many more indicators that other traders use to make sure that this right here actually lines up. Something tells me that this right here didn't even have the correct number of indicators. It was essentially off of this right here that indicators may have crossed, and as a result, the retest gave them that cross to enter, and it just buyers came in and pushed price as high as possible, and they got their profit off of it. Honestly, I think that's honestly what happens. I want to go down from 30 minutes. Well, we're in 30 minutes. We can't really see much more than what we have here from the hour time frame, aside from much larger candles, way more interesting action up there. It's pretty much the same thing though. I want to dive down into the 5 minute. Now we're getting to a lot of candles in a very short span of time. Very short span of time. Essentially, what am I seeing? I'm seeing a huge amount of volatility. Up, down, way down. Huge spike up. As a result, it comes back down slowly. Huge leg up, down, back up. That does nothing. And that's honestly, every time I open up TradingView, that's my thought running through this app is I see a bunch of up, down, up, down, up, down, up, down, up, down, and no real way of reading this without first drawing a opening line, closing line, and figuring out highs and lows, and honestly referring to the trading strategy. And I think that is the best thing to do is to open a chart and then find your notes and then go down a summarized list of notes so that way you can further yourself in actually trading. Okay, so I added a second note over here. about order blocks. If an order block has been confirmed under the correct use of confluences from all info listed above, moves to equilibrium to determine where to enter as price moves. So, based off the order block that we saw a second ago, almost forgot. Based on this right here, this order block right here, we can move to equilibrium from this low all the way up to, honestly, from the highest high, because we have order block right here, from the high here to the low here. We'd have, actually, yeah, because this would have already been formed. This would have been confirmed, and this would have been the next day as a result. Because this was confirmed, we would go from the low here, and I guess wait for it to leg up, and as a result, that would be our confirmation that price wants to move higher. We'd wait for this to get tested again. I think how we would do that is because looking at it like this, right? We don't know that it's been confirmed yet, so we would be taking information from this right here. We'd be looking for the highest high, which is right here, and the lowest low, which, for the most recent sake of purposes, we're going to go high here and then low here, right? If we wanted to go even lower, we could do this right here, most recent low versus the most recent high. We would have drawn an equilibrium there, and boom, let's just look, boom, down to here, boom. We would have waited for, well, this doesn't really depict it. This is where I get confused about the Fibonacci tool, because I know it's an indicator, I know what it's supposed to do. My gist, my concern is when I'm looking at charts like this, right, where I'm looking at high and low, but here's my lowest low all the way down here. I know any one of these red candles can be considered a low to those who are experienced. When it says the most recent lowest low, I'm thinking something like this right here. But on a day scale, where I'm looking at many days, this is what, a week? Maybe a week, I don't know. I guess we'd look at the high to the order block low, because we read left to right. I'm not entirely sure what direction it's facing in, but I don't know. There are three different areas that I assume it's going to be. It's either the lowest right here, the lowest right here, or if it's the part that makes sense, it's the lowest low, the first low off the order block, off of the move, liquidity sweep down, in my opinion. I'm not entirely sure. It helped me out with this, experienced chat people. I'm not entirely sure what I'm going with. Again, though, from this, I guess, marking the highest high and lowest low of Monday going into Tuesday, you can kind of see, I guess, where price would dip, right? And we have our confirmed low here, and we would look at it like this, right? Our guess would be where, if this is an order block, where price is going to go up. Check this right here, where this imbalance is for the sell side, and then we want it to go into this white. If it goes higher, that's okay, because it's in the range. It's the body that we care about into this, I think. And as time moves on, we can see a body and a wick into that, and indicating that yes, there is an order block. Price is going to want to move up, and as you can see right here on this candle specifically, I know it's hard to see, we did get a strong move up as a result of it. It's reacting off of this to go back down. This was that double bottom we discussed earlier. It came back down and retested this. This would have been a fair entry to leg up into this, but from that point, yes, this would have been a profit, but it would not have been a true amount of profit compared to this right here, which is where I think another strategy that TJR mentioned came from. He explained that based off of this order block, this double bottom right here, in a different manner, is essentially we could take all of the higher highs, so this right here, right? We can go all the way up to here or go left a lot. This is where I'm confused, because my understanding was I could take this high and every high over here and hope that the genuine hope was that from this purchase here we would make bank all the way up here, right? Not entirely sure what else to say about that. Because there is no high elsewhere, it's just that specific high that would be taking profit on. Again, I know this is 5 minutes, so it may be as simple as buy here, take profit from here, 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 and that'll be it. I think that's a more accurate description of order block and how you can use that to make profit. But I'm trying to figure out how that ties into, I guess it ties in the way it's explained. Each building block that he teaches, liquidity sweep, order block for value gap into equilibrium and all that other mess, is essentially a layer of protectiveness against yourself. You form that solid line of building blocks, and that is the safest you're going to get with trading. That is a guaranteed you're going to make a profit off of it. However, wading through each one adds a level of safeness and certainty that you will be making a profit, so long as you can trace out the equilibrium, showing that yes, if this candle reacts off of whatever liquidity is there, that it is in fact going to skyrocket and you will be making more trade. For instance, I'm guessing this right here would have been it, because this would have been the leg up right here. We would have gone from high to low, and this, I think, from the looks of it, would have been the where are you? Good gravy. I don't see a candle on that. We're going to do this all the way down to this right here. This candle did not reach the white zone. So I honestly have no idea. I don't know. Look, I'm not seeing. Oh, it's up there. Right there. Still didn't hit the white zone. So yeah, I have no idea how that strategy is supposed to work. Huh. I don't know. It's supposed to add a layer of protectiveness to your risk factor. So each building block decreases the amount of risk. The risk is what you could lose versus your profit gain. From, don't get me wrong, from this point up to this point, sure, that's a major profit gain. But from this point this way, it's a guess unless the Fibonacci tool isn't wrong. Like, it's a guess. Yeah, that I said it accurate the first time. It's a guess when you're not entirely sure based off of building block failure, right? When it's a failure, I believe that's when this other note comes in. If at any point one of the building blocks does not appear, then de-risk until equilibrium based on the most recent higher high and lower low confirm a discount price. So based on this, right, we would need to wait for the next building block to occur. That is the confirmation that price has come back down, cleared liquidity, and then moved up again. Again, that is a simple, like, guess. That's as simple as it gets. What do I think price is going to do? Where is it going to go? And how is it going to affect my risk to reward, my profit to loss ratio? Let's look back at the notes right quick. Determine where to enter as price moves. After confirming where the market wants to move, use the steps above on a very small time frame, 5 minutes or less, in order to get a price at discount so the return from a higher time frame moves pay. So this is meant for a day-to-day trade deal for throughout a solid week. So let a day play out, figure out what happened in said day, and then make a move based off the week. But if there is no building block within Monday, wait for a building block Tuesday. So that way you can further figure out where price wants to go, take it at educated guess, and then, or educated wish, if it were to fail, and figure from that where to go. On the 5 minute, we wouldn't be seeing much because, again, the days have not formed out that much. We would not be seeing the large bit there. But per the hour, we'd see what price wants to move, where it's moving, and how well it's doing. Again, that's why we look at the daily and the weekly to confirm whether or not, before we go into the 30-minute, hour, 5 minute, 1 minute, it allows us to determine what exactly we're looking for throughout the days. So it's not a guess all the way through. We're not guessing based off those building blocks. It's a constant back and forth look at many different things. So for those who are super new to trading and don't understand exactly what I'm talking about, this is essentially what I'm talking about right here. I've been streaming for 3 hours and 15 minutes. I think it's okay because I'm pretty sure I've only spent 20 minutes talking about all of this with few interruptions. So we're going to continue. I think another hour ought to do, though this could be more than an hour. For this bit, I think I'm going to go over the building blocks so that way maybe some of the stuff is a little bit more understandable, relatable. Again, these are notes taken from TJR's YouTube bootcamp thing. I'm just relaying what I jotted down, and hopefully it makes sense to someone. And if anyone experienced manages to see this, if for any reason you find something that doesn't make sense, or why did I type it like this instead of the actual way it's supposed to be typed, or the strategy or how I wrote down the description of, let's say, a building block, candlesticks, or equilibrium, or something else just doesn't add up, let me know. Because, yeah, I don't really know where else to go with that. For now, I guess we'll go ahead and stick to the notes. We have candlesticks. What are they? What do they do? They describe price through the size of both body and wick. Makes sense, right? Green is up, red is down. Candlesticks represent movement, the wick. The open and close of price movement in a section of time, the body. Makes sense. 5 minute, 10 minute, etc. The wick left behind represents the position or the movement of price after the close of a candle body. Essentially what I said before, where price can move in both directions. Similar to this right here. It can move in both directions, but the body represents the open and close, and the price movement is everything between ends of the wick on both sides. Green candles mean bullish, red means bearish. So, bullish candle right here, bearish candle right here. I think the same can be said for trends. If the general trend is up, you see a large green stick on the daily. Boom. Same concept. Because guess what? Each of these candles represent a single day. Bullish, bearish, bullish, bearish. I don't know about that. I don't know why it's stacked on top of each other. I don't know why. But bullish, bearish. Bear goes down. The bulls up here. The bears are in their caves hibernating. The notes were up the entire time. I've got to keep remembering. Bullish candle, bearish candle. Simple as that. Candlestick patterns and what to look for. These count as one confluence towards making a trend, knowing what candlestick patterns are. These will show price action. Doji, there are multiple variants of this type of candlestick. Small body candles showing indecision in price action. It doesn't know where it wants to go. It shows when the market fails to close above where price ought to be. So, again, price doesn't know where it wants to go. As a result, it closes lower than what it's supposed to. While price continued higher, oh wait, hold up, did I skip? Yeah. Oops. Or price continued higher or lower than the market's action. And it was a continuation of the sentence. So it fails to close above where price ought to be, while at the same time price continued higher and or lower than the market's action, than the amount of time. So the market itself was open from point A to point B within that candle, but the price itself went all over the place because it didn't know what to do. To have a strong pull in price means the candle should close above where doji candles typically close. So, doji, I believe this is what's called a doji candle right here. Yeah, small body, large wick. It closed above where this doji candle was. As a result, price moved higher. The flip can also be true, I think, because this candle here is open on top, close on bottom, right? I think this means that if this were a doji candle, yeah, this right here, perfect example. Doji candle here, large wick, small body, closed below where this ought to have closed. Doji candle here, closed above where this doji ought to close. So it's inverted for bearish market, bullish market. You have downtrend, uptrend, and this indicates that price wants to move down. This indicates price is going to move up continuously. Simple to understand. I have a lot of editing to do. Ugh. Let's see if my audio is even picking up. Yep, it's picking up. All good. Okay, so we'll go back to this. Doji, confirmation. Doji, confirmation. Make sense? Cool. Find info on candlesticks and bodies and relate them to price action. Done. Trends. A trend is a major movement in market. For example, large red or green dips or spikes that lay the foundation for the opposite to occur. Okay. So, green spike, red dip. Higher time frames hold up. Or, movements that present higher highs and higher lows in a single uptrend. Up, higher high, higher low, higher high, higher low. Think staircase. One step up, one step down, one step up, step down. Cool. Generally up though. And then the opposite is also true in a downtrend with lower highs and lower lows. Downtrend. No, it's hard to see there more accurately here. Lower high, lower low. Make sense? Or I'm sorry. I am wrong about that. Higher high off of this green candle. Lower low off this candle. Because this right here did not break past this. Or this. Or this. Or this. Make sense? The low is what is lower than the previous candles. Not the most immediate after the previous green. Makes sense. Boom. Higher time frames hold higher power. Look at trend to use as confluence. This counts as one on the weekly chart first, and work your way down to the time frame until satisfied. Weekly and daily for confluence of where price is going. Hourly to determine on the day where price is going. 30 minutes to confirm it's not going to break up structure or retrace. 10 minute, 5 minute, 3 minute, 1 minute. Just to narrow that view. I'm gonna eliminate two of those. I'm gonna eliminate the 10. I'm gonna eliminate the 5. the 3-minute and the 1-minute, for the use of determining where to trade, pinpoint exactly. You know what? I'm going to change that again. I'm not going to do 5. I'm going to say change it to 5 and 3. Don't do 10. Don't do 1. 1 is too little information and way too quick to really dial in on someone who's new. 10 is too much information too slowly to really dial in. 5-minute to build the blocks. 3-minute to enter. Beware of retracements are inevitability. Retracements are inevitable. It's going to happen. You can't control it. Get over it. Watch for momentum change through break of structures on 1 week time frame compared to 15-minute time frame. So, this I think is wrong. The break of structure on a 1 week time frame says that the move has changed from an uptrend to a downtrend, break of structure. Instead of going higher high, higher low, we went from higher high, higher low to a lower high, lower low. Lower high down here, lower low down here. It went like this, right? This is our trend, and our break was somewhere in this right here, because this was our high. This was our high, and then I guess like that, right? High, low. The reverse can also be true in a downtrend. It can reverse into an uptrend. So you have lower high, lower low. Instead, you have higher high, higher low, right? Or higher high, higher low. You get the point. Those are inevitable. The comparison should not be made to the 15-minute time frame. The 1 week time frame tells you where price is wanting to go, right? Large spectrum of time to determine. Day hones in on that time, so you can see a more accurate representation of each week and where price ought to want to go. Daily takes precedence. Weekly says power. So for instance, we're going to go here. Oh my gosh. We're going to do this. Boom. Back down to weekly. Boom. Yeet. Boom. Weekly is strong. Large amount of weeks going up, right? So general up. We have few down. We did not break structure except for right here. No, we did not break structure. That is a higher high. That is a higher low. High, low. Keep in mind. We have not broke structure at all, except for right there. That was the first break of real structure right there. So from this high to this low, this was the higher high, higher low, right? I think we broke structure on this candle actually, because I'm looking at this right here. Though it didn't make... No, I'm wrong. That was higher low, higher low. This is the first true break, because we're lower than both of these. So lower high, or lower low, lower high, lower low, lower high. And then we broke structure again over here. On, I think this candle right here, we broke structure into a higher high. And as a result, we didn't see a lower low, or a low candle until this right here. And of course, that structure has continued going up since. And it has not really broke. That was the first real low. We did not break that. So yeah, it just kept going. We have not broke structure since. However, I feel like we're about to break structure somewhere in this. We are like in between here and here. We're going to have a structure break potentially, I think. That was September. That's August. I think price is going to come down. Honestly, it might go back up, but again, this is the weekly time frame. Each one of these candles is a week, so we can't really do that to ourselves. General trend is up. For the daily, we broke structure on the daily. Just because it breaks structure right here does not mean it's going to break structure and continuously move down on the weekly. Price still went up. So that holds all the power. What was I going to say? The comparison is between week and day, and then from the 30-minute, or no, I'm sorry, the hour, from the hour to the 30-minute comparison, right? Because each one of these candles is an hour, single day now, right? From this right here to the 30-minute, boom, solid comparison. Where is price wanting to go? Again, keep in mind the higher time frames and exactly where their price is wanting to go. From the daily time frame and from the 30-minute time frame, you ought to have a clear picture of where price wants to go, and so you can begin to move down to the 15-minute, or in our case, I'm going to go 10-minute. Not to enter a trade, but for building blocks, I can't go to the 10-minute. Fine, 15-minute. Anyway, the lowest frame you can go in that doesn't throw an ad in your face, you can, from the next interval down, whichever one you choose, 15, 10, doesn't really matter, you can set up your building blocks for the week to determine what your strategy is and how it's going to work. And then from the next interval down, I can't go 10, but I'm pretty sure I can go 15, or not 15, 5, and go 5-minute, break it down even further. This is where you ought to start looking for trade entries, because at this point your building blocks have been set, and this pinpoints a more accurate representation on, like, it's to start off your building blocks with a 30-minute, right, or 15-minute, and then from the 15-minute down is when you start throwing in markers that you have your current high, current low, your previous day's high and low, and then your overall general high, general low for that week. Or because we're not in this week yet, we'd be using last week's set of data. So that general high, that general low, and then from there testing it all the way around. Or not the week, the day. Ugh. Sorry, that's my fault. Not week, day. You use the previous day to start your confluences, and then from that you build building blocks on lower time frames. 30-minute again is for comparison on where price wants to go for the day, hours where to go, or the price wants to go for the day. 15-minute, you start putting down your markers, and then from the 15-minute to 5, you look on the day specifically for any entries. Again, with reasonable volatility and with enough confluences within the day, you should be fine. I don't know how. I don't think I've applied it to a day yet. That might be next stream, because I'm working on 3 hours and 30 minutes now, and I've already got a lot to edit down, honestly. We haven't gotten anywhere near halfway through these notes, so that might be next stream. I might just start with notes, and then from there, like, I'm gonna just keep reading notes, ask every now and then what you think should improve, what shouldn't improve, how it should improve, and honestly where you can apply these notes and the building blocks that I'm going with to further benefit in price action and all this other stuff. Use them week as the highest time frame when trading for a week span. So long trades. Movement. Markets move in 3 ways. Indicators, break of structure, trend up. Indicator, break of structure, trend down. Indicator, neither high or low is violated for a similar span of time a trend travels. So go to the previous trend, like identify there's your downtrend. Here is a momentary break of structure. We are still going in an uptrend, and so it is going up immediately after this break of structure. What exactly was it that neither high for the day nor the low for the day have been violated? So you have for the trend, sorry, this is a single span from here to here, and then this right here is its own thing, right? Neither high nor low have been violated for this whole day, so makes sense, right? It's momentary consolidation on the 5-minute. That could easily change. What we're looking for off of this is a breakout for either down or up. And I think what's going to happen is it's going to come back down a little bit, because I'm looking at large, little, and it might be a small bit. It might come in to retest this low here and then bounce up again. We're looking for a double bottom, I think, within this area. That would make the most sense. I know you couldn't see that, but you get the point. This right here, less, it's going to shoot up. I think it's going to come down, test this right here, this wick in particular. It's going to shoot up. From that, we could pretty much, like from this high to this low, from the past 2 days, we can take this and draw. Will a Fibonacci tool work with this? Does it make sense to have a Fibonacci tool here? Maybe. Let's see. Yeet. Boom. I mean, it would make sense. Kinda makes sense. Maybe. Yeah, this is where I'm pretty sure I drew it last time. It didn't make sense. But you get the point. I think it's going to come down. That's my best guess on Monday, is it's going to come down a little bit and then shoot way back up. It might actually test. This might be the test right here, actually. This bottom was broke through by this right here, so it's going to skyrocket up instead of come down. So I might actually be very wrong. I'm new at this. I'm learning. Potential oof. But yeah, here we are. Going back to notes. Consolidation. The indicator is neither high or low has been violated for a span of time. Trend travels, and as a result, we are stuck in a consolidation. There's an indicator to watch for order blocks right after break of structure, because that is the best way to determine a breakout. That breakout will either be up or down, depending on which way trend wants to travel, and per the weekly and daily bias, it wants to go up, so chances are it's going to go up. Potentially. And I want to say this right here is confirmation of order block. It going up and then someone saying, no, shooting it back down. I'm pretty sure candlestick wise, if we were to look at this trend up, this trend down, this candle right here is either, this candle is small but with a large wick, and this right here is a small or a large red candle with a small wick going down off to the bottom. Let's just look at that real quick. This is 5-minute. I think this, from this low, that's 7:55 all the way up here, that's 8:15. So that's what? That's about 30 minutes, yeah? Let's go 30 minutes. Looking in here. Boom, yep. Small candle, large wick, large candle, small wick. That's an order block, I think. That's my opinion, order block. But it blocked, and now we're shooting way up, and it did test that bottom, so I think further up is where it's going to go. I think it's going to break through. Continuation, I think, based on a video I saw recently, to confirm whether or not continuation is going to be a thing, is whether or not this trend here, this specific group of candles, just keeps going green up past this high. If it goes past this high here, at that point, we're looking for a trend back down, and instead of testing this low, it'll have another candle before it hits this high. That low is what we're looking to get tested. When that low is tested, we can expect it to go higher. That's our discount price on the test, and then boom, up high it goes. Make sense? It made sense to me in the video. That's essentially what I'm going off of. And of course, the guy also had indicators. I don't know, I might buy the subscription for this and actually like really go in depth with what the indicators are. So that way it's a simple cut and dry. This video taught me this, and I'm now applying it, and we'll see what happens based on days to come. We're gonna skip 5 because 5 is a personal note per TJR. If you don't know what I'm talking about, go to his YouTube channel, subscribe to him, like his videos, go to his boot camp, because these notes are directly from that boot camp. Break of structure and liquidity, what are they and what did they tell us? Break of structure, shift in trend. Liquidity is the resting orders, stop orders, and limit orders. Okay, that's a lot. Break of structure essentially is a staircase that has one random step that is lower than the previous step. And as a result, it's a change. It's a break of structure. The structure is a staircase moving up. That break is the step going down instead of up. Pretty weird. And that can be inverted. If the staircase is going down, it's the one step up, and then the next step higher. The next up is supposed to be low. If that makes sense. Liquidity is resting orders, stop orders, and limit orders. I don't think it was clarified on exactly what each one of those orders are and whether or not it's pertinent. My understanding is liquidity is essentially money, the transaction of money and how it works in the market. Resting orders is anything where someone has paid for a single share in something, right? And as a result, it's waiting for that price to go higher as a result. Stop orders are anyone who's wanting to sell and the price dropping as a result. And then limit orders, I don't know what limit orders are. I have to look into this. I have to look into what liquidity is, and I'm going to do a deep dive over this for the next week. The next week is just learning about liquidity, because I don't know much about it. Aside from it's another word for what's used in the market. That's all I got. Highs and lows only need 2 candles to form and are not solely the highs from an arch or lows from an arch. Highs from a movement, lows from a movement, general trend, right? It can be as simple as green and red, what I talked about earlier. A green can form a high, red can form a low. Break structure to the upside, meaning we are in a downtrend, is when we have a candle closure above the most recent high. One candle, not wick, solely body. Pay attention to the lows for break of structure. Break of structure to the downside, meaning we are in an uptrend, is when we have a candle closure below the most recent low. One candle is all it takes to identify these. Pay attention to highs for break of structure. Break of structure can be determined when identifying a trend, then either one of the candles listed above appears, giving us an indication that the market is about to change for the former. If we're in an uptrend and it closes below, it may go down. Potentially. Not that it's a guarantee. Break of structure is not when a wick stops at a higher high or a lower low from the former candle pattern. The body alone indicates break of structure solely. Perfect example right here. We have break of structure. Where? We have high here. Boom. On this candle. This candle specifically. Boom. Right there. High. This high is lower. Break of structure. That's the way the notes have read it. That's oh my gosh. It took that long. Big oof. Right here's what I was talking about. You have higher high here on this candle, and it broke structure here. Low. Boom. That's essentially what's happened right there. Let's go back to notes because we're reading them at mock speeds. Boom. Retracement can happen in between break of structure and the next identifiable trend. Interesting. Higher time frame need to be checked before using break of structure on a lower time frame as confluence as it could be a retracement for the daily time frame. So that's going back to what I was saying before, and essentially what the summarization up high essentially said was that just because the lower time frame is break of structuring, like is going back down versus up in a normal uptrend for the daily, does not necessarily mean that the daily is going to start plummeting just because a 5-minute chart says it's going down now. That's not how that works. Maybe this. Liquidity is when a price point is achieved and the resulting condition is others exchanging their money for trade. Literally what I did. Okay, so maybe this might explain liquidity a little bit better for me and for you. Let's see. Liquidity is where orders will be filled. People will need to exit the market while others come in. That makes sense. All while the banks are filling the orders from people leaving the market. How to spot liquidity? This is one of the most difficult concepts to grasp in the market. I'm glad I wrote this down. Is when the most... How to spot liquidity? Okay. When the most recent high is taken out by the next, indicating when a change in the market will immediately happen through a much sooner break of structure confirmation. This is true for the opposite in a downtrend. This is where I put this in. Think for a minute. Ignore this, what I just said, and think. When the price continues to move in a staircase up in an uptrend, regardless of the smaller drops indicating overall trend, the next highest high will continue to form a larger green candle on a higher time frame, in which case, wait. Confirm a break of structure and mark the lowest low and larger time frames in order to achieve the best indication of price discount through past data displays. Do we know what that means, chat? Hey, comment section. Hey, experienced people. Hey, you beautiful people on the other side of the screen, knowing very much so more than I do and have way more experience with the internet. Hot dog again. Boom, I'm back. That wasn't very fast. Or wasn't very slow, sorry. It wasn't very long. There we go. Better accurate words. The thought is, though, screen and I can't see my own notes. Boom, I can see them clearly now. Whew, man. So, I just messed up again. Dang. All because of ads. When you see well, you wouldn't be able to see it. I would, though. So, regardless of the smaller drops indicating overall trend, the next highest high will continue to form larger green candles on the higher time frame, in which case, wait. So this is what we were talking about for liquidity sweeps earlier, why it was so hard to identify. This right here is what we're looking at. This move up right here is liquidity, is essentially what that just said. I know you didn't see it. Let it minimize. Let it do its thing. Hang on. I'm going to keep making that mistake, but that's okay, because that's more I'm learning. This move right here is what we're looking at with what that just said. The higher highs are going to continue moving up, regardless of these smaller dips right here, indicating that trend is moving up, right? It's going to continue forming this higher high. As it forms this high, wait for an order block confirmation. Why? Because guess what just happened? The highs were high until, guess what? We had a break of structure on this candle here. These were both lower highs. As a result, we had a lower low, break of structure, boom. Order block. We had a firm grip up. We're waiting for confirmation on the back down. It retested the first order block. That confirmation was what we needed. And as a result, hello. What's up? You want to go to QT now? Is that what's going on? You're getting both of those out from back behind my bed. I hope you realize it. You messed me up. How did... No, I'm messing with you. I'm messing with you. Confirm break of structure. and mark the lowest low on large time frames in order to achieve the best indication of price discount through past data display. So, essentially do the same thing we did before. So, take this right here and apply it elsewhere. That this right here is in fact an order block, and that we're also going to have a test immediately after. We could test this right, shoot, where would be the best? On a leg up. On a leg up is the best way to go about that. We have leg up here. We're looking for a break of structure along this leg up here. So higher high, boom, higher low here. Because that was the previous. We go high high. Highs are going to keep. We broke structure. There. On that candle, we broke structure. Where's the next lowest low? Boom. Right there. We're looking for an order block. It wasn't much of one. It was a shabby display. Boom. That little bit right there. And as a result, we had come back down right there. Definite break of structure on this candle, if anything. Boom. I guess this would be the order block right here. On this set of candles, we had a leg up. Boom. Break of structure. Lower high there. And as a result, we had lower low. And then, boom, break of structure again. Confirmation here. This tested this low. This was a very small wick on the bottom of that. I don't know if you can see that or not. There's like very little on that. But this tested this low, and this blocked it. This was the confirmation we needed. As a result, price went higher, and according to higher time frames holding that power, the price moved up. Boom. There's that. You could not see a thing because the notes were open the whole dang time again. I've made that mistake like 17 times on this one recording, on this one stream. Every single time I go to say something about the notepad and then try to refer it to the trading view, on this screen I can see it, and it's not until after I get through saying it that I look over and I'm like, oh, there were words on the screen the whole time. I have so much editing to do because it's been nonstop back and forth, and then just looking over at the screen and knowing my mistake is there, and now I've got to be like, ugh, I have to fix that now. We're looking at this leg up, though. This is the order block we were looking for, and this is the confirmation. This candle right here. We had a firm order block there, and as a result of the higher time frames holding the power, price skyrocketed and kept going up. Good gravy. I cannot believe I keep making that same mistake. You're going to teach me. I'm going to learn this. Someone's going to teach me. Because, so, when price drops into discount, confirm a large time frame break of structure in order to discern where price will want to move afterwards. The goal is up because we all want to make a profit. Purchase at the discount price and then sell at the next highest price. Make a profit. Confirm a large time frame. I'm reading this twice because guess what? I'm learning. Confirm a large time frame break of structure in order to discern where price will want to move afterwards. So, let's go back to where was the first example? It was this right here. From this movement right here, right? This is on the 30-minute time frame. We can clearly see break of structure on this candle. We move up, order block here, order block confirmation, discount price here, move up. On a larger time frame, not the we don't want the span of a day because that would take out the look of what it looks like. So from this candle here to this candle here, no. Both of these candles will have different looks. It'll be from 5:30, 6, so it'll be hour. On the hourly time frame, we should be able to see it. On Tuesday, 2 different candles, boom. And this is what I was confirming before. We had higher high, higher low, break of structure, lower high, order block. Large green candle, and then of course we had a close higher than the low. There's a second break of structure confirmation. Order block because the wick, the price movement, was the same as the green. So confirmation, and then per the lower time frame, because we had a smaller dip in this candle here, remember, that would have been our entry point for where price would want to go. Because we had the order block confirmation after the leg up, we knew price was going to continue up based off of higher time frame confluence. I'm learning a little bit as we go, so a little bit. I am learning. I can't go to the 10. Keep forgetting. We're going to do this. Boom. Going back to notes. Now that we know what liquidity is and how to spot it, we can look at liquidity sweeps. That is essentially when a move up is taken out by a move down. And then as a result of the order block, the sweep is when that liquidity is then replaced with, guess what? New liquidity from fair value gaps, which is what we're getting to here. Order blocks and fair value gaps. What do we learn from this? Order blocks happen at the tops and bottoms of a trend. Think up, down, up, or down, up, down. Essentially, it's when an order is placed or filled depending on the trend, and immediately after the move repeats itself into a repeat move. That's an order block. That's literally this right here. It's this right here. You have move down, out of trend, and then repeat move, down, order block confirmation, entry point, and liquidity, profit. This is a double bottom pattern. I did not realize I took that in a more complex way, but that explains how, like, a more in-depth look into a double bottom pattern you can simply make profit off of when you look at this, and then in a repeat move, it just tests the previous move, and it confirms that, yes, this is both out of trend and it's going up. The reverse can be said for a downtrend. If it were a break of structure to the upside, we see a double top and know that price would keep going down after the confirmation that the high was broke by the second high, forcing the price back down. So after the move repeats itself into a repeat move, this action can be found by identifying 3 movements, not candles, using the directions listed above. They will always be found either at the tops or bottoms of a trend. These are not to be mistaken for a consolidation, nor are they meant to be used to indicate break of structures or fair value gaps. Why? Because they are break of structures, and fair value gaps happen on their own. These are the moves right before a liquidity sweep. The sweep is what we're looking at here. Potential strategy. This is something, a personal note of mine, while I was watching the video, while I was jotting down notes, just looking. Look for order block to be made on a large time scale, then wait for retracement off of the initial reaction. Initial retracement. And place entry of trade after a break of structure towards the bottom of the move. Right there is where I'm talking about. Oh wait, you can't see that. Dang it. The notes were saying place an order there instead of there. Wait for the confirmation, and at the bottom of the move, place an order there, and then go up. Because this will confirm the liquidity sweep, but because this move happens before liquidity sweep, this is optimal choice to enter and make the most profit off of. In my opinion, that seems the most logical. In my opinion. Going back to this though. Once I have, did I go past that? Once that was the potential strategy. Once it's identified that there is a leg down into the liquidity sweep, assume there will be a break structure into the opposing side after the liquidity sweep. So that would be wrong. That would be wrong. Is that wrong? I think that's wrong. Chat, correct me. Hi. I'm not entirely sure if that's right or wrong. This word right here. That's the word that is wrong, I believe. Because after liquidity sweep, we don't see a leg down. We don't see a leg down. The price is moving up. Based off the confluence, that would be completely incorrect. Once it's identified that there is a leg down into a liquidity sweep. This would be the leg down into the liquidity sweep. Assume there will be a break of structure into the opposite side. I'm guessing it's talking about this right here specifically, which means this is right. What I just, before I said it was wrong, that was right. This move confirms that there will be a liquidity sweep because it happens right before one. All I'm looking for is a leg down. That is going to happen. Once that leg down occurs, it fires off into a liquidity sweep and we get our profit off of that entry down there if we were to get that potential strategy. Not saying I'm doing that, but that is where we enter. Fair value gaps are large candles in the market where there is no liquidity. Think one big green candle, and on either side of that big green candle you have one more candle. Neither candle wick on both sides of the larger can be anywhere but the middle of the one big green candle, displaying an FVG, fair value gap. That's what I was talking about right here. There is no candle between this point here and I want to say this point here, but again, this is counting one candle on either side, not multiple candles. So I'd be looking for this candle here with this candle and this candle. This wick does not touch anywhere in there, and this wick right here doesn't have one. The most recent one would be the one that's counted. So from here to here, technically, that was a fair value gap until this one right here decided to come in and sweep that. So as a result, this is where I think price is going to want to go, because that is the most obvious fair value gap that there is right now within this week. Price might come down here, test it, and bounce off, but because it's going up, I feel as though if it were to come down, it's not going to be very far, and instead it's going to create a double bottom, creating our creating a confirmation that this right here is going to continue up. With that being said, because we did have a break of structure here, this is the confirmation that it's coming back down, boom, up on a larger time frame. Yeah. I think that's pretty much all I have on notes right now. Did I read all of it? I don't think I did. Proposing sign up. We found anywhere there is a big move in the market on any time frame. Remember, higher time frames hold higher power. So, fair value gaps can be found anywhere, so long as there is a large body candle on either side of that candle. One candle, not multiple. One candle. The wick of both of them are not interfering with the middle candle, the large one that's creating that large spike. For those of you who are new and don't understand what news is essentially large-scale events, literal news. Think your news station, go to Fox 5, or any local news station you click on TV, or go to newspaper even. Newspaper holds major events too. The front page event usually has significant impact on specific markets depending on what that news is. These are resources that I took from TJR for the best representation is forexfactory.com, right? Not sponsored, by the way. That link will take you to essentially a site that says different news stuff. The general information, though, is to look for it. Make sure to check off the specific currencies in order to receive accurate news and eliminate clutter on the site listed, USD specifically. I'm trading in the US dollar. I need the US dollar to perform well in order to make a profit. If it's not going to perform well, I know the trend is going to dip all over the place, and I'm not going to get an accurate reading on what exactly I could be making for the day. News is extremely important to check before any and all trades. News extremely affects market. Always check before trading to ensure the best trade possible. If there is little to no effect on the market, 25 minutes after news is out, consider trading defensively. Look not to trade. Check new details and read out the currency to ensure the specific currency being traded isn't being affected positively or negatively. Never trade on a red folder day until 30 minutes after the final red folder or of that time period. Folders including CPI, PPI, FOMC, and NFP are to be avoided. Never trade when any of them are visible. The site will display a forecast and actual, and these are really the only two, I think,
I kind of have an idea
to look at, right? The forecast essentially says what the general public is expecting of that news, and then where the market is at now. The actual is where it's at that minute news is dropped. Click the detailed folder. essentially on this site there are like little folders that have different colors. You have you have the normal one, right? You have a silver one, and you have a red one. The red ones are to look out for. I think there's an orange folder too. That's like next to red. It's best to avoid those at all costs. From what I've learned from TJR. Look and read the usual effect in the details to determine what is going to happen in the market. So, for example, currency, the example used is USD versus DXY. I'm not entirely sure what DXY is, but it's US dollar against DXY, not the S&P 500. If it says good for currency, that means bad for every pair in the market going against the US dollar. So, DXY for USD. News does not indicate the direction of the market for the day. Warning, expect the market to rebound after news, but always lean on the side of caution when placing trades for that day after news. What happens depends on which currency is on which side of the slash, so this right here. Think USD JPY, the US dollar versus the Japanese yen. Yen? I'm not entirely sure what the currency is for that. I don't know. It's yen? Okay. So if the actual is less than the forecast, that means it's good for currency. Then the US dollar pairs will show a reaction to the upside. Kind of like this. The Great Britain pound versus US dollar. If the forecast, I believe that's what that just said. No. The actual. If the actual is less than the forecast, good for currency, that essentially means Great British pound, good for currency, price goes up a lot for anything that's on the left side. For the Great British pound on the left side, if it were against the US dollar, it'd be the price goes down for it, right? And then flip it. If the US is on a good day, right? Is on the right hand side and it says good for currency for USD, the price will go down. If it's on the same right hand side, USD bad, price will go up.
Actually, I thought zenny was a real currency, but it's fictional completely.
I thought it was real too.
I looked it up, and it's inspired by Japanese, and one zenny is worth about one
millionth point zero.
No, it's Jacko, the Galactic Patrolman.
Really?
He says that one zenny is worth about 1.5 yen.
Wow.
So it's a little bit more.
That's crazy. Okay. I did not know that. Fun fact for the day: zenny's not real. Interesting.
I thought zenny was real.
Could you imagine?
I thought it was some kind of I thought it was Japanese currency.
Yeah.
Then I remember one.
What's the Chinese thing then? What's the Chinese currency? I thought that was zenny or whatever.
No, that's.
I know one uses actual their thing is actually called rupees.
Yeah. I don't remember exactly which one it is though.
It's yuan or something like that.
Yuan. That's a
YUAN.
Okay.
Yuan.
Not being judgmental, that to me is weird. But he's judgmental right after. Meme. Anyway. I'm going to get back to this right quick. For looking at USD, JPY, right? USD is on the left, JPY is on the right. So the US is against the Japanese yen, right? USD, if the forecast says, or the actual says good for currency, that means the price is going to go up because the USD...
It's apparently worth less than $1.
The yen? Yeah.
Yuan.
The yuan, yeah.
Yuan is worth 0.14.
Yeah.
United States dollar.
I think the yen is also worth less.
Let's find out.
Like the US dollar for a long time was tied to the golden standard, so if gold went up, USD went up.
Oh my god.
Yeah.
So yen is 0.0067 of $1.
Way less. There is a serious difference between the two.
It's cost like $500, I think, for like a month in Japan or something like that.
Yeah.
Because
it's so much cheaper there, yeah.
Yeah.
And, but their numbers are ridiculous. You have to have the numbers down, otherwise it doesn't work. Because their amounts per charge are like in the thousands, but convert it to USD, that's like about the same price, like less, a little cheaper, but it's still like
it's not that.
Sometimes it depends on what you go to shop for. Getting back to this though, I mean the examples are there. They're obvious.
One peso is 0.050.
Always make sure to click the folder though to read exactly what is going on with it and what exactly will happen as a result.
Korea that uses rupees.
Always be sure to look at that too. I'm not entirely sure what happens on news when it comes to the S&P 500, if it affects it at all. If I'm not mistaken, it is USD that S&P is in, but I don't know if it's against the S&P or what. So I'm gonna guess. Click the folder, and if it says anything about the S&P, stay away from it. I'm not entirely sure. I'll dig into that later on. Real notes in the section again to confirm understanding. New bias is not end all be all. Just because news is out does not necessarily mean you cannot take a trade. When price is so volatile that there is no clear depiction of what is going to happen for the day, that's when you avoid it. Or look at what's happened before and guess, right? Because we're using that word in this. Guess, based off previous data, what's going to happen next. What are you expecting next from that building block line that we just went over? And from there, where would you expect price to move? That's where you're going to make profit. Equilibrium. This is regarding the Fibonacci tool that we were using earlier for the high and low. Trying to determine how price is going to go into that zone of yes, goodness, and then come back up, or in the reverse, go up and then back down. A retracement tool used to indicate where premium and discount markets are in order. High and low values of entries are in order for smart money to enter. It's a two-way range tool used to indicate where price is with a range acceptable for purchase, cheaper on sale. Cool. After you get through the boot camp from TGR Trades on YouTube, you go through a mock-up. Essentially, he asks you questions, and you jot them all down, and you answer them after the video is over with. That was the homework for that video, if I'm not mistaken. And I've answered a lot of them, to be completely honest. I did not know a lot of it. I'll be truthful, I don't know a lot of it. But there are a lot of answers that can be given, depending on situation. So, set lot size. Set a single large amount to have in a trading account. Then use a percentage of that amount in a single trade once a day. I believe in the video he gives you... sorry. There are different variations of this. You can either set a set lot size or a calculated lot size. Calculate percentages based on initial amount and applied income from elsewhere for better risk management. How many trades am I taking in a day?
Less than half a second. It's another 100 p.m.
That is one. In a single day, because I don't have all the proper resources to go into a day of non-stop trading day after day after day. In my opinion, I think I'm going to stick to the week-long trades just to get the most out of a single week. I get that's a safer bet. I'm not going to be making as much as if I were to go day trading and actually day trade, right? I get that's going to be different. I'm sorry this is so boring. I know I'm taking forever. We want to get food.
New record. My shortest EV.
When am I trading? Unfortunately, I have to trade during freaking Asian session.
It's my smallest EV ever.
I understand that is the worst session, according to a lot of people on YouTube, to trade in, because the price action volatility is so low. There is no action, there's no profit, there's no loss, there's nothing. You're sitting on a straight line until something so bad happens on news or something so good happens that completely throws out every strategy you could have for New York session, London session, the like. What session? I want to trade London, but my active hours are during Asian session. Potentially New York, pre-New York session. I could catch on a bad work day, a pre-New York, but I'd sleep through the day. I wouldn't get a decent trade. So I would have to rely on building blocks from the past week to inform me of the current week, just to figure that out. After news or on news at all. Never on the 4. Never on major holidays. Maybe depending on the number of red folders for USD when there are only 2 or less. And I believe TJR goes into the specific ones that matter most and which ones don't.
have this as
going back off of the notes from up here, news is not end all be all. There could be a potential trade in it.
Strongest one.
There might not be. That is entirely on what is happening per the building block
because he's got a
segment.
I don't like that.
What am I trading? I'm only trading the S&P 500 at the moment.
This
Once
one-
mastered, maybe futures or crypto.
My luck.
Later on, only pick 2 for a duration of 3 years.
Either.
That's after I have been trading
With
for
my luck,
a
it probably would
while.
be
I'm going to change this entirely.
even if I wanted
Not
to.
futures, because I don't want to
But
blow my account on a mistake I might not learn until I hit futures.
I'd say it's
Crypto,
probably either
I don't mind crypto because it's going places right now. But then again, that could change in the next 10 years. We won't know until we find out. This, I'm going to completely throw out. I'm sticking to one until I feel so confident I can look into another pair and I easily identify stuff in relative to better volatility with higher volume, with cheaper shares.
My luck.
That's what
It's
I'm
either
looking for.
report or number.
No, I never get
What am I going to enter? How am I going to enter? Sorry. What are my confluences?
My luck.
Liquidity sweep plus microstructure,
Oh my
and
gosh.
TJR goes through his
Yeah,
very
hydro.
different setups on how he would go about each one of these, and in what order he would go about finding them first. I like this one right here specifically, daily bias, liquidity sweep, and breaker structure,
If I'm just downloading
because it
10
is
million viruses,
the part that works. Like I've been able to identify those in the past. I think sticking with that is going to be my best bet at becoming successful. Just to learn the stuff, and I understand that going less on the building blocks means I'm taking more of a risk. Not necessarily that they'll be successful, but that risk is greater than if I were to simply wait out and attempt a trade with more confluences to further back my guess.
I wonder if I
The
can
above are
actually
orders
take
of
those
confluences to
that
confirm,
use
then
that
use before taking a trade.
and like look at
I like the ability of doing that. Trades can be entered and exited on any given time
considering
frame.
that they're all images.
Doesn't matter. What matters is price action.
I just
Manage all
realized-
risk to reward ratios equally
So I've
through
got a number,
out
and
the
then a
plan.
point, and then a line.
Stay in the risk of
Take each
reward,
number
and
as
we're
the
pretty much
Pokemon,
good.
and then the numbers as the
Execute
variance.
only when plan says to. Backtest all plans before deciding to enter. Zero emotion. This is me, personal note. I have to go into a trade knowing I could lose everything. Not good, but that's part of the trade. That's how it's going to learn. That's how it's going to work every time.
Over
Putting everything together.
1,000.
I think this is a perfect spot to stop.
No, that would be
I'm not
sick.
going to read any further. I'm not going to do anything. If you guys enjoyed today's stream, drop a follow. If you enjoyed the video, drop a subscribe. There is a like button to both. I'm not sure if it's a heart. I'm not sure. I'm pretty sure YouTube's a thumbs up. Comment down below what you think I can improve on, what you think I should change, what you think, honestly, I can do to better my odds in trading. If the notes are as sound as could possibly be, then honestly, yay, I'm going to buy a subscription for this, and I'm going to attempt to trade next week. Potentially.
Pretty sure. So it'd be like
Potentially. There are a lot of factors that go into that, and it's not just a time and day, unfortunately. But yeah, comment down below what you think of this, if it's acceptable to stream this kind of content on Twitch, knowing I stream a lot of game stuff.
oh wait, no, that would be okay. Now
As time moves on, I hope to really delve into this more in depth.
it would be the
If I can rely on this as a day-to-day income stream for me, then so be it. I will gladly take this over my current job. But yeah,
Ask AI.
yeah. Hope you guys have a good one. See you next time.